Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri, and today, ladies and gentlemen, we are discussing about the Business and Data Analytics August 2023 paper. The question of focus today is question 22. It reads as follows. Riziki Limited is considering a project with the following details. Initial cost, 40 million. Residual value, 2.5 million. Selling price per unit is 1.1. Variable cost per unit, 500. I meant 1,100, pardon me. Then variable cost per unit is 500. Fixed cost per year is 5 million. Additional information, annual number of units sold is 30,000. The project has a useful life of 5 years. The company uses a weighted average cost of capital or WACC of 12%. Required, A, compute the base net present value. B, carry out a sensitivity analysis of NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. C, prepare an appropriate chart to indicate the different NPVs for each scenario in B above. Note, adverse variances in this case means a decrease in cash inflows or an increase in cash outflows. So what we're going to do, ladies and gentlemen, you can see towards the right of the screen over here that we've developed inputs: the initial cost, the residual value, the selling price, the variable cost per unit, and the fixed cost per year, and the project life there. So what we're going to do then, we're going to now identify the inputs of the major inputs towards the right. Like for example, what I mean is this. We are going to now talk about the base. Here we're going to talk about the base case, input based on the input. So base. That. And then towards the right, we're going to include a 5% initial cost or positive value of 5% initial cost. So we're going to have plus 5% initial cost, like that. And then we will now then have the adverse scenario where we have negative 5% annual unit sales. So negative, I'm going to do like that, negative 5% annual unit sales. So with that, we proceed on to get or to also identify now the 5% selling price. So negative 5% selling price. Then we continue building on the model itself. Right here we have variable cost. Now, increase in variable cost. 5% variable, 5%. I'll explain variable cost. And then we're just following these components right over here. So we began with the initial cost, then we went to the annual unit sales, then the selling price, then you're going to the variable cost over here of 5% variable cost, and then residual value. There, so negative 5%, negative 5%, residual fixed cost. I think I forgot fixed cost. So positive 5%. apologies for that, positive 5% fixed cost. And then we're talking about residual value right here, residual value. %, residual value. That. So with that, we are saying that we're told to compute the NPV. So the inputs, then we just follow the inputs based on whatever we've been given. So the residual value right over here, we can come to the initial cost. You can see the initial cost is 40 million over here. So it's 40 million. We're just doing the base case scenario over here. So what I can do, I can put this perhaps on that side like that. So that now, and maybe perhaps I can, with your permission, I can just compress it a bit over here like that so that you can be able to fill out this part. So the initial cost right here, you can see is 40 million like that. So 40 million. And we come down there. So we want the comma format, guys. The comma format. So we highlight everything, put a comma, then just like that. So here the initial cost plus that value there. Then we have the residual value going down. The residual value is given to us over there. That value there. Because we talk about the base case. And then the annual unit sales. The annual unit sales you can see is right here. Additional information number 1. So 30,000. So just put plus 30,000. Because this is in words, it's not separated from the words. So it's in figures combined with the words. So just put 30,000 there. We have the selling price per unit given to us. The selling price per unit, you can see, is given to us on the right here. So enter that. The variable cost per unit as well, given to us there. Enter. Then the fixed costs per year have also been given to us there. So plus. Enter there. The project life in years. We have been told in note number 2 that the project has a useful life of 5 years. So we just indicate here 5. That. So what happens then when we have an increase on initial cost? So the increase in initial cost will be, we can put 5% over here because we're saying it's going to be 5% increase over here. So you put just 5%, and we increase. So this will all require this to have a percentage. So allow me to do this, to do the following, to put this as percentage over here, comma format here, that. So don't worry about this. These are just the marks that are being allocated towards the entire question. So you can see it's 30 marks over here. So with the permission, then I can just do away with that, or rather I can just put them beside the questions over there. However, I can just do away with them for now. So with 5% increase, we just come over here plus that value times a factor of 1 plus, we're increasing it by 5%. That's what it gives us. 42 million. With 42 million, we are saying the residual value remains as the way it is over here. Because we're saying that the residual value will remain as 2.5 million all through, whether there's going to be an adverse effect or so on and so forth like that. So here is 2.2 million like that. We proceed on. And even the number of units, this will be the same. The annual unit sales will be the same, 30,000. Here we are saying it's going to be 1,100 like that. So I can just copy these values as the way they are towards the right there with your permission. Because we are saying that the initial cost is the one that is only increasing. So here, just a copy, paste special values. Let's say okay, that. So if that's the case, what happens when we have a decrease in unit sales? 5% decrease in unit sales, because we're saying from the question right here that carry out a sensitivity analysis for the NPV assuming adverse variance of 5% for all the inputs except the project life and weighted average cost of capital there. So we are saying that now we want to put adverse effects over here. So we are going to have negative 5% like that. You can see it's even indicated to us over here. So here we are saying is going to come back to this, because we're saying we increased it from this to this based on the 5%, but now it's going to come down. And so I'll increase now each of these items moving towards the right there. The annual unit sales, the selling price, the variable cost, and so on and so forth. So that now right down over here we can now do the workings effectively. So you can say plus that value times 1 plus it should be because you're decreasing this value over here 1 no so I think this is the formula. It's plus that value. We're decreasing it by 5%, so it should be delete plus this value, and then we're multiplying it by, open the brackets, 1, decreasing it means, so it's going to be, we're subtracting it from 0.05, so 1 minus 0.05, that. It shouldn't give us 1 minus 0. We talk about 5% adverse effect, because we're saying from here, if we increase this one by 5%, so then decreasing it should be able to give us them. It should be able to give us take us back to where we actually were before, were there. So it should be just 40 million. That. And with 40 million, then we are saying that we can move ahead and say that variable cost is going to now also selling price the variable cost is going to decrease over here. So we put negative 5% in terms of selling price. Sorry, so negative 5%. So we put that, and it remains the same over here. I'll explain that. If you're talking about the variable cost itself, also it also remains the same like that. So it's going to remain, including the residual value like that. But what we're saying is that here we will need then to put 5%, because we're saying it's 5% variable cost, 5%, then negative 5%. Because it's positive there. So we are saying what? That in terms of the initial cost, if it's going to increase, it's going to increase by 5%. If the unit sales decrease by 5%, then it's from this increase, it's supposed to decrease to 40 million back again. Then what about the residual value? The residual value should remain the same, with the exception of the very final residual value down over here. So it should remain the same here. So we just maintain it like so, up to there. But you're saying that the very final one over here is going to, this residual value is going to be plus that value times open the brackets, 1 plus should be that value there. The residual value represents an inflow of money when you sell the asset. So we are saying that at this point over here, the residual value, a 5% decrease in residual value will cause it to be over there. That. So that's what we have. We proceed on to discuss the next item. Talk about the annual unit sales. The annual unit sales will affect what? Will affect this component right over here, this column over here, the annual unit sales. So here we are saying it's going to decrease, so plus that one times, open the brackets, 1 plus that 5%, negative 5%, 28,500. But the rest remain the way they are. These other values remain the way they are. So 30,000. So plus sorry, pardon me for that. And so it should remain 30,000. That should remain the same. Control R. It's only the unit sales. Why? Because we are saying that the unit sales are the ones which are being affected. The sales, we are dealing with unit sales. So this annual unit sales component should actually change. Next item is the selling price per unit. So what would change? So selling price per unit, this is what is going to change. That part there is going to change, pardon me. That one is the one that's going to change. So here we are saying it remains at 1100. So here we are saying it's just going to be that, because it has already changed. This one remains the same, but the selling price changes based on that component there. So we are saying the selling price is going to be plus that one times, open the brackets, 1 plus selling price comes to 1045, but the rest remain the way they are. How about the variable cost per unit? Variable cost per unit remains the same with the exception of the variable cost component. So here we expect it to remain the same. So we drag it up to there. But that value times, open the brackets, 1 plus the variable cost is increasing. 525, then the others remain the way they are. The fixed cost per year. The fixed cost per year, we are saying is going to be 5 million with the exception of the fixed cost component. Or just put it like so, up to there, Control R. So this one is just going to change plus that value times, open the brackets, 1 plus that value, and we enter. Then we remain with enter. We have it like that. How about the project years? The project years remain the same. We've been told it's 5 years, so it goes without saying that it's going to remain 5 years. Just leave it like that. And with that, now those are the inputs that we've worked out. We now want to proceed to work out the solution. So the unit sales, we start by identifying the unit sales over here. Unit sales, over here we have, and of course here we have the base case given to us there. This one should be slightly above here because we do not fill in. So base case. That. Then here we are saying we're going to now put in the figures. The unit sales, 30,000. So we have them there. And then we copy these components towards the right here. Copy. Towards just the right here. Database, just the same way. Then we have the initial cost is going to be how much? We're just going to copy and pick it from there. So the initial cost in terms of the unit sales is just going to be the same. You can see that because we're talking about the initial cost here. So when you're talking about the initial cost, we're just going to copy it like that. So enter. So the initial cost, we just pick it over there, just from above over here, because the initial cost is going to be an increase. So then the annual unit sold. So we just then autofill, Control R, with the exception of this one, where we're saying the annual unit sales changes over here. Remember how we did it over here? Is what we're saying actually changes there. The next component is the selling price. Selling price. So we move like so. Selling price. Price. And the selling price or SP is given as plus that value. Enter it like that. Remember where it changes. It changes at the point where we have the selling price component there. So if it picks from above there, so just put it like so. You can see the selling price changes at that point here. Next component, next item is the total sales. Total sales. And you're saying the total sales is going to be given as we multiply you're just going to pick the values here given to us over here, total sales plus, from the question, just to clarify over here, one second, I get it. It's just going to be this value of here, selling price, times that value. That's what we're getting. Sorry. And once we have that, we proceed on to identify the next component there. And with that, we're saying we'll just be able to just pick the values, dragging them over here. Sorry, I was just having a bit of a small hitch. Sorry for that. So Control R. And you can see what happens there. We just pick the selling price and then we multiply with the unit sales. So what happens then now with the next component? So those are total sales. Once we have the total sales, we pick the variable cost per unit. Variable cost per unit. Sorry. Per unit. And the variable cost per unit given to us there is just going to be 500. You can clearly see it, it's just given to us over here, 500. So we just pick it. Remember, we're just picking the values the way they are over in the base case. Enter. And you remember the variable cost component changed at this point. You remember it changed at this point here where the variable cost was actually increasing at 5%. So it changed to 525. So we just move towards the right and then Control R. How about the total variable cost? So here, with your permission, I'll just move this a bit towards the right. For here, I can say variable cost, total variable cost. Total variable cost. And the total variable cost will be given as variable cost in terms of shillings times the units. Put towards the right, Control R, and it picks. Once we have the total variable cost, we can be able to pick now the sales in terms of the variable costs, the sales variable costs, so sales. Variable cost. Sales variable cost. And we can see that it is just going to be the total sales and then we add the total variable cost. That's what we are going to do. So it's going to be the sales, which is there. Then we add that value. But there's one thing. The variable cost is a cost. Please note. So what we're supposed to do is that we're supposed to put this in form of a negative sign there. So apologies for that. Put a negative. Put it like that. Then I move it towards the right there. So that now we can be able to indicate or be to show that it is actually indeed a cost. And so you can see the sales variable cost actually changes there. So now what is left is for me now to just drag it like so. Please note one thing, that the unit sales were given to us there. The selling price was also given to us there. The total sales is just the unit selling price times the unit sales. The variable cost per unit, we had already computed it right above over here, and we say that this variable cost component over here is going to change by an increase of 5% increase variable cost. The sales variable cost right over here is just given to us as the total sales minus variable cost. So the sales less variable cost gives us this value here. How about the fixed costs? The fixed cost is given to us there as follows. 5 million. It's right here. So we enter, and because we're saying it's a cost itself, so let's put a negative sign there to show that it's a cost. Then we move towards the right like that. Remember, the component of fixed cost over here changed, 5 million and 250. So we're putting it a negative over here just to indicate that it's a cost. And with that, we can be able to then identify the cash flows. Cash flows. So the cash flows we have over here are just going to be 18 million, and then we subtract 5 million. Or we add. Why I'm adding is because we need to, is because we're going to subtract. Please note. So we're going to add. If I subtract, it's going to be 18 minus minus, which comes to plus. So you should be able to just add it right there. So get 13,000. 13 million, pardon me. So 13 million. Control R. Move towards the right. And those are the cash flows. But remember one thing, that there was a residual value over here that we didn't factor in. So we just put it in there. So the residual value year 5, so you can put it year 5, is a cash inflow. So of how much? We pick those residual values from up above here, please. There. Then, because there's a change in residual value over here of 2.375, we need to factor that in. So Control R, but we do not subtract it. It's a cash inflow. So then we are going to, or we'll need then to get the present value interest factor. So down over here we'll have PVIF, present value interest factor, year 1, times cash flow. Times cash flow. Which cash flow? These ones here. So we'll do the same. PVIF year 2 times cash flow up to year 5. So year 1, year 2. So I'll just change this. It's going to be easier to change that. Year 3. Year 4, then year 5. Cash flow there. And how do we get the present value interest factor? We're just getting the present value interest factor. Could put the interest rate right above over here. So interest rate, it's at 12%, all through 12%. So here we put that, and we 12%. So it's going to be plus the cash flow and then we discount. We are discounting it. Discount it against open the brackets 1 plus that value, close the brackets, power 1 times yeah, not times the cash flow, it's already been multiplied like that. So we enter. So once we have that, we shift Control R. That is year 1. Notice what I've done over here. You can see even the formula is power 1. So here I'll do power 2, power 3, power 4, and so on and so forth like that. So because I want the cash flow, so it's going to be plus that value over 1 plus that one, power 2, that. Then you do the same thing. One plus R power 3 like that. So here is going to be this power 3. Yes, power 3. So power 4. Sorry, I was just having some trouble with the mouse. Sorry. So plus the cash flow over, open the brackets, 1 plus power 4, that, then finally we have power 5, but we will also need to work out the residual value right here. So the residual value, then the cash flow is going to be plus that value over 1 plus power 5. Enter. So Control R. Then we have what is called the residual value. Residual value. So you can say PVIF, value interest factor, year 5, times cash flow. That's what you do. So this is residual value. I should change this to enter, just to do that. And we're saying that the residual value was what value? Residual value was that one over 1 plus that value power 5. Please note it's power 5 because there's a cash inflow that is coming in at the end of period 5. Just to confirm that it's okay. Yes, that's okay. So from there, we get the total PV. And I can just be able to indicate it using a bottom border, thick border, the bottom, thick border at the bottom there. You can say that we're getting the total present value. Present values is going to be those ones there like that, up to there. Then I just drag it towards the right, Control R, it gets the total, and I bold that, Control B, as well as this one I Control B, like that, to show that that's the total present values. But remember, part A is requiring us to get the net present value. You can see here, compute the base net present value. So we need to deduct the initial cash outlays. So initial cost, you're saying plus, should I say plus or should I say minus? So say minus that value. The initial cost is there. So 40 million. Remember, the initial cost over here will change. This value here will change based on whatever you calculated over here. You can see it's 42 million. So we just change Control R, that, we get the NPV. Put it, Control B, then you put a top and bottom border, plus then it may not be very clear, so I put that thick border there, and then I put also this other border here with your permission. It's just presentation, good for presentation, characteristics of good financial models there. So with that, then we have the scenarios. Part B, carry out a sensitivity analysis for NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital there. So the base case, so we'll have, so part B here, can do it just down over here. So the base, we just almost like sort of copying this. Down over here. Then we have the NPVs down here, because we have the NPVs given to us over here, and net present values. NPV. NPVs. So just pick those ones. Then once you pick one, then you just drag it. With that, we can then just, now we've done that, carry out a sensitivity analysis, we've already done the sensitivity analysis, prepare an appropriate chart to indicate the different NPVs. So part A was to compute the base case NPV. We have already done that. The base case NPV is this. Then from there, we are told part B to carry out a sensitivity analysis of NPV, assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. Adverse effect. So the initial cost, was given to us over here as 40 million. So we've done an adverse, the opposite, the adverse, by increasing it of, or rather, by increasing it by 5%. So we've increased it by 5%. Here we've reduced the unit sales by 5%. The selling price we've reduced by 5%. So we're trying to answer part B, carrying out a sensitivity analysis assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. Now, So we cannot have an adverse effect for the initial cost. We cannot, unless it's an adverse effect, it means that the initial cost increases in value. That's what we mean. It cannot reduce. If the initial cost reduces, it means it's an advantage to us because we are spending less. You get the point? So the unit sales is now when you're getting a negative value over here. The unit sales decrease. The selling price also decreases here. The variable cost, because it's a cost, the only way a cost can be an adverse effect is if it increases. That's what you're saying. A fixed cost is, because it's a cost, if it increases is when it becomes an adverse effect. For residual value, becomes an effect when the value actually decreases, and that's why we are putting these values differently there. I hope that point is driven home. So with that, then I'll just go to part C here. So we've done a sensitivity analysis for the adverse effects of initial cost, selling price, fixed cost, variable cost, and residual value. And then we are told to prepare an appropriate chart to indicate the different NPVs, each scenario in B above. So what we'll do, we just go towards the right here. Towards the right. And we come and we move on to insert. Once you go to insert, we can come to recommended charts. Click on recommended charts, and you can see whichever chart pleases you, you can be able to recite it, so long as it yields whatever we actually need. So this one, maybe perhaps select this value here, this one. You say, okay. So the different NPVs that, or the different sets of, or the adverse effects of those values, base case, are actually indicated to us over here. And this means that at the base case, we are actually over there. The initial cost sensitivity plus 5%, because it's a cost. Any cost should be, an adverse effect should actually increase or get a positive value. But any positive value or selling price or what we're selling should actually be indicated by a negative sign if it is going to be an adverse effect. So these are the NPVs based on the initial cost, the annual sales, selling price, the variable cost, and the fixed cost, as well as the residual value. So this, ladies and gentlemen, brings us to the end of question 22, business and data analytics. We hope that you have enjoyed being with Manifested Publishers. Thank you and God bless you.
Welcome to Manifested Publishers. My name is Mr. Dongo. I am an economics lecturer. Today we'll be covering that is Economics August 2024 paper, question 4, and we start with Roman A. We read the question, then we put it on the board. It says this: state 5 factors that limit the success of economic integration in developing countries. I repeat, state 5 factors that limit the success of economic integration in developing countries. State 5 factors that limit the success of economic integration in developing countries. So state 5 factors that limit the success of economic integration, basically in developing countries. Developing countries, first of all, are countries that are not yet developed. They're in the process of developing. And when you talk about economic integration, we talk about these countries coming together basically to facilitate trade amongst member states. And you said one of the examples of this economic integration, a given example is like the COMESA, where you find developing countries coming together in order to facilitate trade. A given example of economic integration is COMESA, where countries come together to facilitate trade amongst member states. In the quest to facilitate trade and facilitation of cooperation amongst member states, there are a number of factors that basically hamper such integration. And some of the factors that we know basically does that is lack of trust amongst member states. We also have a number of things that deals with political instability, probably in the continent where those developing countries are. We can also talk about the difference in currency, may also hamper such integration. But you also know that there is violation, where you find some other members may violate the agreements that are basically enforced in such integration. We can also talk about some of the reasons that why these integrations may not work is difference in the level of technology. The countries that are probably more developed in terms of technology than other countries, and so with such, they may not be able to engage in such integration. But lastly, we can talk about a number of things like external influence. You can find countries that are not within the integration actually coming in and causes mayhem in such agreements. And therefore, at the end of the day, you find that such integrations are not facilitated. We can put them on the board. Say one, lack of trust amongst the member states, lack of trust amongst the member states. Number two, we have what we call violation of agreements. We have number three, very important, we call it external influence. External influence. We can also have political instability, what we call political instability, within the region. Political instability within the region. And lastly, we can talk about what we call difference in currencies, what we call difference in currencies. Difference in currency. We can add one. We have that is difference, what we call difference in the levels of technology. Difference in the level of technology. That when we have difference in the level of technology, that may also hamper agreements within the integration. And that is basically how one should approach this very question. And in looking at that question, the examiner is very clear that it needs 5 points. So the 5 points meaning that each point is equivalent to 1 mark. So as you do that, you must make sure that you're within those points and you can provide extra so that you stand a chance that even if you're not in a position to get the second or you're not able to get the third, but you have an extra mark on that, then you'll be able to get the whole question. That is how we basically approach that very question. We pick it on the next question, still on question 4, Roman B. So this is what the question says. Distinguish between debt distress and debt conversion. So we put it down on the board. That is B. Distinguish debt distress and debt conversion. Distinguish debt distress and debt conversion. Distinguish the debt distress and debt conversion. one of the things that comes to our mind is when you talk about debt, we need to understand that being in a developing country, and Kenya one of the developing countries in Africa, we need to understand that one of the major policy issues is management of debt, because you realize that these countries are not able to fund their budget, that most of their budgets are funded through debt. And so therefore, then there's need for proper debt management in such countries. And some of the terminologies when you talk about a numbers of issues pertaining to debt, we'll have what you call debt distress, and we have what you call debt conversion. To be precise, when you talk about debt distress, is inability of a country, when a country is unable to fulfill its financial obligation. That is the debt distress. When a country gets to a point that is not able to fulfill its financial obligation as a result of the debt, that is what we call debt distress. And debt distress basically will lead to what we call debt restructuring, that you need to restructure the debt as a result of the distress that comes as a result of not being able to fulfill financial obligation. On the other hand, when you talk about debt conversion, when you talk about debt conversion, we are basically saying that conversion of a short-term loan to long-term loan and vice versa, where we typically we say that we typically exchange debt at sustainable discount. Exchange the debt at a sustainable discount. We can put it down and say debt distress. We say that debt distress is inability, is a country inability to fulfill the financial obligation. That is what you call a debt distress. And debt restructuring, and therefore debt restructuring is required, and therefore debt restructuring is required. You get to a scenario where you are so much faced with the debts that you are not able to fulfill your financial obligation, and therefore what you call the restructuring of debt basically will be necessary in such circumstances. Then we proceed to what you call debt conversion. Debt conversion. What you call the debt conversion. So when you talk about debt conversion, we basically say refers to the conversion of short-term debt to long-term debt, conversion of short-term debt to long-term debt, and vice versa. Conversion of the short-term debt to the long-term debt, and vice versa. Or we can basically say that exchange of debt, what we call exchange or stroke exchange of the debt. We say stroke exchange of the debt, typically to a sustainable discount. Typically to a sustainable discount. That is what we call a debt conversion. That is what basically we call a debt conversion. And very important to understand again on these very questions that we have, very important to understand is that if the marks is allocated 4, it therefore implies that Once you define the debt distress, that should account for 2 marks, and debt conversion 2 should also account for the 2 marks. That should also account for the 2 marks. And that's a question that is doable and manageable. And if you look at this, this is one of the areas that actually affect, is one of the emerging issues, especially to the developing countries, and is one of the areas that learners need to pay attention. Because if you look at these countries that are developing, Africa and having a majority of the countries that are developing, they're faced with a number of debt issues. And so we need to give much attention to that. That is how we approach that very question. We pick on our next question. That is August 2024. That is question 4, Roman C. We read the question, that we put it on the board. Outline 6 method that may be adopted to clear external debt in developing countries. Outline 6 methods that may be adopted to clear external debt in developing countries. We raised and said that debt is a major policy issue, meaning that debt is a factor that needs to be considered. We said majorities of these countries that are in developing world rely mostly on debt. Why that? The reason is that because they're not able to fund their budgets using their own sources of revenue. And so they have to rely on debt that is basically from developed countries in order to fund their budget. So the examiner clear is asking us, how do we get to reduce? How do we get to reduce? What are some of the methods that we get to clear external debt? Because these obligations actually affect the growth of a country. So we can put that on the board. Outline, that is C for C. Outline 6 methods. Outline 6 methods that may be adopted, that may be adopted to clear external, debts in developing, countries, to clear external debt in developing countries. Something very important to understand about when you talk about debt management, those are basically touches on macroeconomics. And this is one of the areas, again, also, you're not so much limited into approaching these questions. It's not limited to what you find lecturers will give, but this is a very open way. If we look at our country, for example, Kenya as a case study, what are some of the ways that are very common in a country dealing with clearing external debt? One of the very common that we know as the citizens of a country is that, that the country uses, Kenya being a case study, is widening of the tax bracket. One is what we call it widening of the tax bracket, tax bracket. That essentially means that i.e. increasing the taxes, i.e. increasing the taxes. That one of the ways that they deal with the external debt when it's too much, and how they manage it is increasing the taxes. We know that number 2 is what you call austerity measures, where government reduces. Also a measure, Kenya being a case study, we know that a country is dealing with a lot of austerity measures, where a country is reducing expenditures. Number 2, reducing a country's expenditure, so that much of the money that is available can be used in order to pay the debt, can be used to pay the debt. And very important, number 3, we talk about debt conversion. And debt conversions, we basically say that you can convert short-term debts to long-term as a way of reducing. So we talk about number 3, what you call the data conversion, i.e., converting short-term loans to long-term loans, and vice versa, to long-term loan and vice versa. Converting short-term loans to long-term loan and vice versa. We know that when you talk about long-term loans basically take a longer time for them to be repaid or for them to be cleared. A country may decide to dealing with this long-term loan and making them short-term so that they can clear them within the period. So we can also talk about what you call increasing government borrowing. Increasing the government borrowing. You can also increase the government borrowing in terms of internal. You can increase the government borrowing in terms of internal so that you can repay the external debt. Increasing the government borrowing, increasing the government borrowing from central bank to clear. We say to clear external debt. To clear external debt. But very important, one amazing thing that a country can do. A country can also decide to seek what you call debt forgiveness. Seeking debt forgiveness. The number of points that you can be asked where we say a country can refuse to pay debt as a way of doing away with the external debt. But the most precise and most clear way is seeking of what you call debt forgiveness. But you can also touch on what you call promoting investment so that they can have money to pay the debt. Say promoting investment so as to generate profits to pay up the debt, to pay up the external debt, so as to pay up the external debt, so as basically to pay up the external debt, that they can promote investment within the country so that they can pay up the external debt. So they can also decide to avoid rescheduling of the loan. But that basically touches, because you can have it, touches on conversion, avoiding rescheduling of the loans. We can have that as the last, avoiding. We can have it as avoiding rescheduling of the loans, so as to pay up in time. So as basically to pay up in time, that the country can decide to avoid rescheduling of these loans so that they are able to pay them up within the required time. That is how we basically approach that question on how do we reduce, what are some of the methods that basically we use to reduce the external debts. We'll pick it in our next question. That is August 2024, question 4, Roman D. This is what the question says. Highlight 5 limitations of quantitative theory of money. Highlight, we put it down. Highlight, question 4D, highlight highlight 5 limitations. 5 limitations of quantitative theory of money. Highlight 5 limitations of quantitative theory of money. So we need to understand what basically quantitative theory of money talks about. So when you look at quantitative theory of money, it basically talks about MV, which is money supply times velocity, is equals to price levels times the number of transactions times the number of transactions. A number of limitations that are basically envisioned in this theory are that the theory does not address the theory. One of the limitation, we say number 1 limitation, the theory does not address the issue, what you call the issue of interest rate. Does not address the issue of interest rate. And we basically know that interest rate is one of major policy on monetary policy. Monetary policy that we know we use to address a number of issues, in economics. We can also have number 2 limitation on this theory. The theory does not address the future. We basically say the theory does not address the future. This theory does not basically touches on the future. The theory does not address the future. Then we can also talk about is too much concerned. Number 3, we can say too much. We say too much concerned with money supply. Too much concerned with money supply, that is circulation of money supply, and ignores the demand for money. So when you look at the formula, one of the things that we have on that theory, it's concerned money supply times velocity is equals to the general price levels times the number of transactions. So this theory basically focuses on issues to do with the supply of money, but ignores what you call the demand of money. Then the theory does not explain changes in the value of money. We see that the theory does not explain the changes, what you call the changes in the value of money, does not explain the changes in the value of money, and note how money does not explain. The theory does not basically that attempts to explain. This is basically a term. Attempts to explain. Say attempts to explain changes in the value of money, but not how. We say not how money attempts to explain changes in the value of money, but not how money is in the first place determined. How money in the first place determined, not in the first place determined. We can look at the last when we have the last on that. This theory argues that there is no general price level. Argue that 5 argues that there is no general. Argues that there is no general price level. price levels, but rather, we say but rather, series, there's no general price level, but rather series of price levels, series of change in price levels, series of change in price levels, series in change in the price levels, in the consumer price index, in the consumer, what you call in the consumer price index. So those are basically some of the limitations that are basically attached to the theory, that is the theory of quantitative money, or theory of quantitative theory of money. One we've talked about does not address the issues to deal with interest rate. We also know that it does not address the future. We also understand that is too much concerned on money supply and ignores the aspect of demand of money. We know that the theory attempts to basically explain the changes in the value of money, but does not address how money in the first place is determined. That is how we approach that very question. That marks the end of question 4.
We move to question 4. Question 4. I wrap this, assuming we have taken it down. Okay, so we move to question 4 of the paper. Question 4 is all computation. Part A is testing taxation of insurance companies. Part B is testing VAT. So let's start with Part A. Riziki Insurance Company Limited was incorporated in the year 2019. The company deals with different classes of insurance. The following trial balance was extracted from the books of account as of 31st December 2021. So we have a trial balance balancing at 23,420,000 shillings. So it is a trial balance, meaning it has balances of assets and liabilities, it has revenues, it has expenses and all that. So it is upon us, therefore, to differentiate, separate the items that we need and only pick those that we shall use to answer the question. So we have a trial balance. Additional information 1 says, claims intimated and outstanding as of 31st December 2021 amounted to 750,000 for motor vehicle insurance and 480,000 shillings for fire insurance. So this is a question testing taxation of general insurance. Remember, the activities of an insurance company could be in the form of general insurance and life insurance. So the rule is, where an insurance company offers both general insurance and life insurance or life assurance, then the two are treated as separate businesses and they are taxed separately. So this is on general insurance. And general insurance again can have different classes. Like in this case, we have motor vehicle insurance and fire insurance. So let's analyze the additional information. 1 says, claims intimated and outstanding as of 31st December 2021 amounted to 750,000 for motor vehicle insurance and 480,000 shillings for fire insurance. Now, claims are almost the major expense of an insurance company. So just like in any other businesses, we can have claims outstanding at the beginning and at the end of the year. So here we have 3 figures that we shall have to adjust for each of these. We have claims outstanding, that is accrued claims brought down, that is at the beginning of the year. We have claims paid during the year and claims outstanding or accrued
at the end of the year. So in short, we shall have to adjust the claims account so that we determine the figure to the income statement. 2. An earned premium is maintained at 80% and 50% of the net premiums received for motor vehicle and fire insurance respectively. An earned premium is maintained at 80% and 50% of the net premiums received for motor vehicles and fire insurance respectively. Now what do? In tax, the government taxes taxpayers on income earned, not necessarily what is received. So what we shall do here is simple. We shall work out the net premiums received. Net premiums received is simply total premiums received less premiums returned. In insurance business, as a company, you can receive premiums from your insured, but then because of certain reasons you may have to return. So net premiums received is simply the difference between the two. So what we shall do is simple. Determine the net premiums received, then deduct the unearned premium so that we only tax that which has been earned. 3. Investment allowances have been agreed with the Commissioner at 1.2 million shillings for the year ended 31st December 2021. Investment allowances have been agreed with the Commissioner at 1.2 million shillings for the year ended 31st December 2021. Now, this insurance company has non-current assets, like the first item in the trial balance is property, plant and equipment at 10.2 million shillings. We know this depreciates, but for tax purposes, depreciation is a disallowable expense. Instead of depreciation, we allow for what we call capital allowances or investment allowances, which are computed at a uniform rate for all businesses. 4. So we shall allow this as an expense instead of depreciation. 4. Investment income analysis. So in the trial balance, we have an item they are calling investment income, a total of 4.15 million. Sorry, 4,150,500. 4,150,500. So this is the analysis. 1. We have interest received from government securities, 2,040,000 shillings net. Net here means after withholding tax has been deducted. So interest received from government securities, 2,040,000 shillings net. Now, interest income is subjected to withholding tax at the rate of 15%. So net here means this figure is 85%. Now, the next thing is, how do we treat interest income received by a company? This is a company. Now, for companies, withholding tax of 15% on interest income is not final tax. So what we shall do is simply to gross the amount given, that is get 100% of it, tax the 100%, but when computing the tax liability, we shall deduct the withholding tax of 15% already paid. Next, we have interest received from local banks. Interest received from local banks, 760,500 shillings net. Net again means after withholding tax of 15% has been deducted. The treatment is the same. We shall gross the amount, tax the gross amount, deduct the withholding tax already paid when computing the tax liability. 3, we have dividend received from a Ugandan company. Dividends received from a Ugandan company. That reminds you to remember your treatment and classification of dividends. Now, this is dividend received from a Ugandan company, meaning it is a dividend income received from outside Kenya. The rule is that is an exempt dividend. So remember your classes of dividends. We have exempt dividends, qualifying and non-qualifying. So this being an exempt dividend of 450,000 shillings gross. Gross means without or rather before any taxes. We shall leave it out as an untaxable income. We have dividend received from a local company of 900,000 shillings net. 900,000 shillings net again means after withholding tax has been deducted. For dividend income, withholding tax rate is 5%. So that means this is 95% of the figure earned. So this is dividend received from a local company. Now the correct classification is this is a qualifying dividend. So what we shall do is simple. Qualifying dividends are dividends whose withholding tax is final tax. So we shall not tax it again. We shall not tax this again because it is already net of withholding tax. 5. Fees paid to investment managers amounted to 750,000 shillings for the year ended 31st December 2021. Fees paid to investment managers. This is an allowable expense, and so we shall show it as one of such. Required: 1. Taxable income or loss for Riziki Insurance Company for the year ended 31st December 2021, and 2. Compute the tax payable, if any. So this is what we do. We say we are answering question 4A. So we show each class in a separate column. So we have motor vehicle insurance, motor vehicle insurance. We have fire insurance. Then we have total here. Then show the currency. Okay. So we start with the premiums. So if you look at the trial balance keenly, there are a number of items touching on premiums. So 1, we have gross premiums received from direct clients. So we can start with that. Gross premiums received from direct clients. So motor vehicle, we have 3 million. Fire is 2.5. The sum should be 5.5 million. Next, we have gross premiums received from agents. So gross premiums from agents. Motor vehicle is 2 million. Fire is 1.2 million. That should be 3.2 million. You can get, if you go to the trial balance again, down, we have what they are calling premiums returned. That is payments that were received from clients, but paid back again. So we have motor vehicle is 800. We deduct. This is 700. A total of 1.5 million. Another thing touching on premiums is whether here up to here we can get net premiums received. Net premiums received. So net premiums received is total premiums received less what was returned. So for fire we have, this is motor vehicle, this is 5. 5 minus 8 is 4.2. So we write here 4.2 million. This is 37 minus that is 3 million, a total of 7.2 million. Then we use information 2 to work out unearned premiums. So we say less unearned premiums. That is 80 and 50% respectively. 80% for motor vehicle and 50% for fire. So we begin, we get 80% of 4.2 million. That is 3360. 3360. So up to there we can get earned premiums. So that will be 3360 from 4200. I get 840,000. We move here. 50% of 3 million is 1.5 million. Less that is 1.5 million. So total earned premium for the year will be the sum of the two. 840 plus 1.5. That should be 2340. This is 15 plus 3360, 4860. Good. Next, we add other taxable income. So we say add other taxable incomes. Add other taxable incomes. We only pick those that are taxable. So we make use of the trial balance and the additional information. One, we have what they are calling commission. Sorry, before we go to other taxable income, there's something else touching on premiums. We have what they are calling reinsurance premiums paid. That is, insurance premiums paid by this company to a reinsurance company. So we should deduct that so that we have what we call net premiums. So we say reinsurance premiums paid. So for motor vehicle it is 400. For fire it is 150. That is 550. So we get the difference again. We get net premiums. This is 440. This is 1340. 1350. 1350 plus 440 should be 1790. 1790. Up to there, we now bring in other taxable income. So say add other taxable income. So we separate the other incomes and only use those that are taxable. One, we have what they are calling in note 4 investment income. Investment income. One, we have interest from government securities. So we write here interest from government securities. So the amount is net, so we gross it. So we shall do 100 over 85 of 2040. We do that together. 100 over 85 times 4, 2040. That gives me 2400, 2.4 million. We add it here. Next we have interest from local banks. Interest from local banks. The same process, 100 over 85 times 760.5. We do it together. I get 894.71. Yes. Dividend from Ugandan company not taxable. Now in exams, if you don't make use of any item provided in the question, please explain why under your notes and assumptions. So you can say under notes and assumptions, one, that dividends from a Ugandan company is an exempt dividend, hence not taxable on Riziki Insurance Company. Again, I repeat, dividends from a Ugandan company are exempt dividends, therefore not taxable on Riziki Insurance Company. Two, dividends received from a local company are qualifying dividends because withholding taxes have already been deducted. So you can say dividends received from a local company are qualifying dividends, hence not taxed beyond withholding tax. Dividends from local company are are qualifying dividends, hence not taxable beyond withholding tax. We go to other incomes, if they are there. We have what they are calling Commission on reinsurance ceded, that is a taxable income. Commission on reinsurance ceded. So that reminds you to be able to understand what we call commission on reinsurance ceded and commission on reinsurance accepted. So commission on reinsurance ceded is a taxable income. Commission on reinsurance accepted is an allowable expense. We bring it here. We say commission on reinsurance ceded. For motor vehicle, we have 700. This is 300, a total of 1 million. Any other income? We do not have any other, so we can get total income. Total income. So remember, we are asked to get total taxable income of the company. So we are basically interested in this column here. So we have 1790 plus 2400 plus 894.71 plus 1 million. That should be 6,084.71. That becomes the total income of the business. Because we are using the gross profit approach, we move to the next step and say less allowable expenses. We only use those that are allowable. So we go to the additional information 1, which is about claims. So we run claims as working 1. So I want to run working 1, which is about claims. I can do it here, then we shall wrap. So working 1, claims. So we run claims account. Claims account. So we start with motor vehicle. We are carrying 3 zeros. So if you look at the trial balance keenly, we have what they are calling claims outstanding as at 1st January 2021. That is accrued claims brought down. So motor vehicle, we have 1.1 million. So we write here, balance brought down 1.1 million. Then you have balance carried down, information 1. Claims outstanding as of 31st December 2021 amounted to 750,000 for motor vehicles. So we write here 750. Then we debit the account with the claims paid. So we write here bank. So claims paid for motor vehicle is 2770. 2770. Balance of the account. We do it together. 2770 plus 750 is 3520. 3520. Income statement, that is allowable claims, will be that minus 1100, which I get to be 2420. So that will be the allowable claims for motor vehicles. We do it for fire, claims account, fire, insurance. The same procedure with the same rules. Balance brought down, that is accrued claims at the beginning of the year. For fire is 840,000. Balance carried down, that is information 1, is 480. Claims paid, bank, fire is 2110. Balance of the account, 2110 plus 480 is 2590. 2590. Income statement, that is allowable claims for fire insurance, index 840, 1750. And with that we have the allowable claims. So here we have 2420. Here we have 1750. Get the sum of the two. I get 4170. And with that, we are done with the claims. We are done with this working, so we can grab it. We move to other allowable expenses. We have information 3, which is about investment allowance. So I said those are allowable instead of depreciation. So we write here investment allowances or capital allowances given at 1.2 million total for the year, that is. Information 4 we have talked about, that is the analysis of investment income. Information 5 is about investment managers fees paid. So investment managers fee, a total of 750,000 for both. And up to there, we are done with the additional information. We go back to the trial balance and identify any other allowable expenses. So be very keen. 1, we have commission on reinsurance accepted. Commission on reinsurance accepted. For motor vehicle is 600. Fire 200, a total of 800. Next we have sundry receivables, that is a balance, not an expense. Bank balance is a balance, an asset, not an item, not an expense. We have directors' fees. This is a company, so directors' fees are allowable expenses. Directors' fees is 495 in total. We bring it here. 495. Reinsurance premiums paid we have dealt with. Claims outstanding at the beginning of the year we have dealt with. Claims paid we have dealt with. Legal costs on claims are allowable expenses. Legal expenses on claims. Motor vehicle is 280. This is 130. 130 plus 280 should be 410. 410. Sundry expenses on motor vehicle claims are allowable expenses. Sundry expenses on motor vehicle claims, a total of 220. Nil for fire, so total is 220. Management expenses are allowable expenses. So management expenses. Motor vehicle 450, 380. That should be 830. Investment income we have dealt with. Premiums returned we have dealt with. Profit and loss account is a balance, not an income, not an expense. So up to there, we can now get taxable income. So taxable income will simply be total income less total allowable expenses. So there are 2 ways of doing it. You can either deduct each of these from the total income. So that would mean we bracket each of them, or we can get total allowable expenses, have it here, then we deduct it from our total income. So let's use the first method. Good. So this is what we are interested in. So we get total taxable income. Be very keen. So taxable income is total income less allowable expenses. So we have 84.71 less, we are here, 4170, 1200, 750, 800, 495, 410, 220 and 830. 830. I have 279, 2790, 2790.29, but negative. So in short, this company realized a loss during the year 2021. So that is part A, Roman 1. Part A, Roman 2 is asking, compute the tax payable, if any. Tax payable, if any. Now, tax is imposed on income. And for a business firm, income is basically profit. So because this particular firm made a loss or realized a loss in this particular year, it is not liable to any tax. So we simply give an explanation for that. So we say part 2, you can write, Riziki Insurance Company Limited is not liable for taxation for the year 2021 because it realized a loss and not a profit. So the company is not liable for taxation in the year 2021 because it realized a loss and not a profit. Then you can go ahead and say tax is imposed on incomes or profit, that is for business purposes. Tax is imposed on income, in bracket profit, but not losses. Yes, so that explains why for this particular year, this company would not have to pay any corporation taxes. And that marks the end of part A of question 4. The topic being tested here is advanced taxation of business income, that is advanced aspects of taxation of business income. The topic is a must in the exam, and in each paper you'll meet at least 2 questions from that particular topic. So be very keen and make sure you understand every bit of it. With that, I want us to move to part B of question 4. Let me wrap this. Part B of question 4. Now, part B of question 4 is a mathematical question again, testing VAT. So that reminds you to have VAT at your fingertips. Know the theory around VAT, it's so much, and then know how to compute VAT and the applicable rules. So I read, be very keen. Zawadi Associates provides consultancy services to various clients whose terms of contract allow clients to pay for the services either before or after the provision of the service. The following information is provided regarding the firm's transactions for the months of October, November, and December in the year 2021. The following information is provided regarding the firm's transactions for the months of October, November, and December in the year 2021. So we have a table of 4 columns. The first column is the nature of the service or transaction. Second column is value of the transaction. The third column is service provision date. And then the last column is payment date. So we have a number of transactions and then all those details. Additional information 1. Siloc Investments was declared bankrupt on 30th November 2021. Now, Siloc Investment was one of the customers, one of the clients, and we are told it was declared bankrupt on 30th November 2021. Let's look at the table and understand what happened in that transaction. So, the transaction was management consultancy to Siloc Investment. The value of the service was 1,440,000. The service provision date was 13th November 2021. Payment date was 40% paid on 30th November 2021. 40% paid on 13th November, meaning 40% of the amount was paid on the service delivery date, and the rest was to be paid later. Then come to information 1. This client was declared bankrupt on 30th November. What does that mean? If a debtor is declared bankrupt, it means you cannot recover the debt from them. So it means you have to write it off, and that means you'll have to, it will reduce the amount of VAT you will collect from this debtor. So what we do is simple. We shall show this as a transaction, yes, but it will be a deduction under output tax. 2. On 5th November 2021, Zawadi Associates renewed its National Industrial Training License for 30,000 shillings and paid for legal fees of 360,000 shillings to follow up on clients who were not paying as per the agreed date. So it had two transactions. One was renewal of industrial training license fee at 30,000. Then 2, it incurred a legal fee of 360,000 to follow up on clients who are not complying with the terms of the contract. So we have to determine if these are vertible or non-vertible items. Now, renewal of industrial trading license fee is not, renewal of national industrial trading license is not a vertible item. So yes, this is an expense, but it will not attract VAT. Legal fees are professional services, and so they will attract VAT. 3. Electricity bill paid on 10th November 2021 was 270,000, out of which 100,000 shillings was payment for outstanding bill for October 2021, and 20,000 shillings was in respect of additional deposits as demanded by the power company.